Good morning, good afternoon. How are you doing? People like Uber shares. I do, even I do. I think we talked about Uber. It's not long ago. So, and I mean, when we talked, if I recall correctly, I mean, it's a like undeletable app. You might hate Uber, but you cannot delete it. I mean, you still need it. So I am along on Uber. I mean, they got multiple businesses, so why not? Why not? All right. Yeah, let's few more people join in. And first of all, good morning, good afternoon, everyone, depending on where you're joining from. Back here, excited to be back on Saturday morning, looking at some markets, some stocks, what's happening, how we can stay in this market, how we can play in this market, how we can stay invested, and maybe look at some companies, maybe look at some businesses of those companies. Today, it's also going to be a little more on mindset training. I mean, I have found investing is more of a mindset than intellect. It might seem little odd, but at least my personal experience is we have to train our mind to be a better investor. And it doesn't matter how great the stock is, or doesn't matter are we intellectually capable of finding a stock at a lower valuation or underrated stock or not. But if we are not trained in our minds to stay with the volatilities of the stock, all that intellect is of no use. So I want to also talk about, basically read through some of the excerpts from Howard Marks' memo, which talks about, is it time to sell? And then other thing I want to look at is maybe spend some time on what I might consider the most important company on the face of Mother Earth. Or if not the most important, maybe one of the most important companies on Earth. And as always, we'll look at what, at a macro level, what happened in the market this week, just to be aware, not that it should impact our investing decisions or our investing profile, but it keeps us engaged. It help us to understand better, and because at the end of the day, all companies operate in a larger market, larger economy. So good to be aware of what's happening at a economic level. Gosh, now I realize, ever since I became a little more serious about investing, that I should have taken economic classes. It should not have gone for engineering and rather should have taken an economic. It's a fascinating, but I recall I used to find it so boring during my college days. Yeah, those were the days of past. But now I find eco very interesting subject. It is because now we have our own money in the market, which is impacted at a macroeconomic factors. Now it makes sense. Now I can understand what I think my professors tried to teach me a few decades ago in the college. Anyway, any feedback? Any new thing you've been doing? What are you looking around? Any new ideas or stocks on your radar? Oh, all done still okay? How is the volatility in the market treating you? All right, so yeah, let's get going with our today's session. Please confirm you're able to see the document. I am okay. Yes, cool. Thank you. Sachin, in India, everyone becomes an engineer first before they figure out what they want to do in life. Yeah, I mean, same case here. I know what I didn't want to be. So the other option was, maybe pick up an engineering course or a medical course. I'm like, I hated biology all through my school. So then there was no other option. Then the other one, okay, let's take up engineering and figure out what we want to do. So yeah, Sachin, you're right. I've been through there, gone through that process. But now I find some of the other aspects way more interesting. But things have changed. Things have changed. I talked to my brother. I talked to my niece and nephew. Now I think things have changed in India. All right. As always, what are we talking? This meeting is all for education. And please don't take it anything as a financial or professional advice or a tax advice. I'm from, I work in a software company, not in a financial services or investment management company. So you can do way better things than taking advice from me. All right, so quick at a macro level. At least the theme was pretty clear for this week, is everything all about inflation. And it's not only this week, I think last few weeks. First, it was worries about inflation. And then this week, we actually had inflation numbers coming out. So overall, consumer price index has risen 7%. So if we didn't get a 7% hike in under salaries this year, which probably most of us won't, we're actually losing money. Our purchasing power has been decreasing unless we try to increase the value of our assets by investing in something else. If we are just holding the cash, there we go. We got a hole in the pail of our purchasing power of cash, and it is draining down by another 7% for a year. Whatever you could buy last year, now we need to, in $100, now we need to have $107. So we should go ahead and ask our bosses for at least 7% raise. Otherwise, we are poorer from what we were a year ago. And this was the largest gain in 12 months since 1982, almost 40 years. Core inflation, excluding food and energy, rose 5.5%. Frankly, I don't even know why we calculate this. It is, the number 5.5% seems good, but core, I mean, food and energy is part of our core living expenses. So I don't have a history of why our labor department exclude this, but I'll ignore it. But this is also one number which is quoted. Producer prices, think that to be aware of, is rose 8.3%. I consider the producer prices index as a precursor, as a canary for consumer price index. Because if producers, the companies who are producing the goods, they are facing inflation pressures. If their prices are increasing, the prices for the raw materials or for the inputs that the producers use, if that is increasing, most of that will find its way into the increase of the finished goods that the companies will produce. So that's why I take this as an indicator of what might happen to consumer price index down the line. So if this month we are seeing producer price index have increased, unless companies find an innovative way to decrease the expenses or to decrease the cost of producing the same goods, or if they can give up on some of the margins that they make, it will find its way in increased prices for the end products. That means the CPI would also increase down the line. So something to be aware of. Bob says, I hate how destructive inflation is. Yeah, Bob, but the worst part is most of us retail investors, we don't pay much attention to this. I mean, we just think that this is the way of life and there's nothing much that we can do about it, right? We still hold all the cash in the bank because, hey, we don't know how to fight against inflation. This is the indirect tax that government imposes on us, either, which is inflation. Now, high price causes worker to demand higher wages, which in turn leads companies to raise prices. And that is why we are seeing all the increase in prices across all segments. But the biggest surprise this week was 1.9% drop in retail sales, because consumers were worried about inflation. At some point of a time, we might go back and either switch to goods that are cheaper, may not be of the same quality, or might postpone our purchases or reduce our consumption if things are becoming way expensive and starting to hit our budgets. And it was seen. Retail sales were down 1.9%. Only positive thing was retail inventories rose 1.3%. Some part of this inflation we can attribute to the supply chain issues, which we hope, Fed hopes, I hope that are transitory. Eventually, once China starts to open all its ports and the whole COVID thing becomes a thing of a past, all the inflation, all that has been that is manifested because of constraints in the supply chain, that portion of inflation should go down, but not all. I think even Fed has now accepted that this inflation is not transitory. For sure, some portion of inflation is definitely not transitory, which is being caused by increase in wages, and actually showed up in the earnings for this week. Once you have increased the wages, it's almost impossible to roll back the wages. Workers won't take it easy. So that portion of inflation that is caused by increase in the higher cost because they have to pay more to workers, that's not going to go back. So, but at least good thing is, if the inventories are rising, if the supply challenges are easing up, that might work out, might help in future to reduce some of the inflation. Quick look at the bond market, 1.8%. I think this is probably the highest in maybe 18 months. In the stock market, because of inflation worries, because of the not worries, but because of the fact that Fed is going to increase the interest rates, we continue to see weakness in especially the tech sectors, especially the high growth companies, which don't make any money right now. So large cap indices, we had a second consecutively weekly loss. So 2021 hasn't been great for stock investors, but it's only 2 weeks, right? 50 more weeks to go. But so far, it's not been great. This was the second consecutively weekly loss to start the year. For NASDAQ, it's been the third consecutive one. And so this week, we saw financials. They kicked off the earnings season. So we look at Citi, Wells, and JP Morgan in terms of what they have to say about their results and maybe a little outlook of what they see in future. Any questions so far on the macro side or anything what you're watching? Cool. Let's look at the sector wise. Only sector that was green is energy. And it's amazing to see how the cycles are turning in whole 2020-21 because of coronavirus and the COVID and all of that stuff. All the energy sectors were the worst performing sectors. And in 2021, it was energy and the financials became the best performing sector for 2021. Almost, it was up high, almost 40%. And this week, it's in just year to date, in 2 weeks, energy is up almost 17%. Sometimes I feel it's too high too soon, but this sector has been depressed for so long. And despite all the calls for more renewable energy, the trend of EV or moving towards more renewables, I think it is still a few more years, at least a decade, before we phase out the fossil fuels. And the fact that not much investment has gone into the fossil fuels or oil and drilling companies. Now, once the economy starts to reopen, the existing, there are a lot more demand. So demand will increase way higher than the supply could. And that's what we are now seeing being manifested in energy sector. We just opening a new well, drilling a new well and starting a new rig. You can't do it in a month or a few months. I mean, it takes a long time. It needs that investment. And there haven't been much investments over the past few years because everyone, there was more focus on renewable energies, and not, also this sector didn't get much love from institutions, investors also. On a long term, yeah, I agree. This sector is probably on decline, will decline like 20, 30 years. Trend is towards renewable energy. But it's we just can't shut off the fossil fuel supply and imagine that everything will move to renewables ASAP. That's not going to happen. So, but because there was more focus on ESG, and the companies like BlackRock, etc., not in forcing their holding companies to be more ESG oriented, and didn't invest or into the fossil fuel. Now we are feeling a little bit impact of it. The demand for fuel will increase as the COVID, the lockdowns, or as the restrictions from COVID starts to decrease, but the supply cannot increase at the same pace. There are no more wells. I mean, the amount of oil wells, operational oil wells, have actually decreased in past few years. And you just cannot create those oil wells at such a short notice. So will be interesting to see. But this sector has been amazing, and that's why it pays to stay diversified in our portfolio. I mean, tech, 2020 tech worked great, especially the small cap tech, the unprofitable high growth companies. They worked great in 2020. Didn't really have a great season in 2021, and not really enjoying anything in 2022. Energy, financials were beaten down in 2020, but have outperformed the markets way more in 2021, and still continue to do it in 2022 so far. So it always pays to have a mix of sectors in the portfolio. Next interesting chart I saw is based on what's happening here. Where are we in this market cycle? And this is how the market cycle always works. Right? This was where most of us were around 2020. Optimism, enthusiasm, exuberance, euphoria. Those SPAC deals, IPOs popping up 40% on the day of listing. Companies that only had paper designs, not even designs, but paper plans, being valued at $20 billion. Companies that faked rolling down the truck on the highway at some point of a time were valued at $50 billion. People just couldn't get enough of Robinhood at $70. Right? From there, now we moved into here, which is the fear, despair, or panic. Now today, Robinhood is what, $16? I don't know. Let's bring that up. Where is Robinhood? It's hit a new low, 52-week low at $14.73. A lot of people wanted to buy Robinhood here, 55, 70. No one wants to touch it at 14. Same is the case with many other these EV companies, or a lot of high growth companies. Now we are into this situation. Panic. No one wants to. So if those companies were really valuable at 50 or 40, come on, it should be. If you're willing to buy it at 40, now it's said available at a deep discount. At 15, no one wants to touch it now. So smiles me a little bit of a panic in that particular sector. Right? Companies like Pinterest, again, I think that was a huge Pinterest, a new 52-week low at 31. Spend most of 2021 at between 50s and 60s, somewhere all the way up to 90. Now it's down 2/3 from its all-time high. It's like snap. New 52-week low. So I have been trying to selling these and get out of this. I understand these companies don't make money right now, Pinterest, Snap. So from a valuation perspective, suddenly they now look less attractive. And we are in a situation where the investors are like, okay, I'm done with this. I want to stay invested only with the companies that actually make some money. And trying to get out at this cycle. Whereas now we are actually approaching a time when it is the best time to actually invest. But invest in a companies that businesses are still performing. I don't care whether the stock is performing or not. Because in due course of a time, the stock will take care of itself. It will follow with the business. But this is generally the best time to invest. But we need to have that mindset of going against what the general market is feeling to invest in this particular time. When everyone is just selling off these companies, which probably had a great business models in terms of the growth, just not making money right now. But we have seen those examples time and again. When my market cycle turns, some of these companies will turn out to be the mega winners. All these mega winners that we have, what we know now, things like Amazon, Netflix, they've all gone through the same cycle. Go back and look at, Apple or Amazon in terms of how much have they fallen from their recent highs. I think I have a chart for maybe Apple or somewhere. Yeah, Apple I have. This is a chart for Apple, which says how much percent has it fallen off its recent highs. Right? Time and again, there will be like 1, 2, 3, 4, multiple instances where it has fallen 75% of its recent high. Pinterest has fallen only 66% or 60%. Right? Many of these high growth companies, which just 18 months ago seemed to be a great investments because they were growing like crazy. They were increasing their users. They were increasing their revenue. expanding their market share, and probably are still doing it, but the share price has fallen 50%, 70% in some cases. This is not uncommon, that amount of volatility. Multiple times Apple have fallen like more than 25%, many times from its recent high. So that's nothing new, provided you have an outlook of, yeah, I want to hold this business because I like this business and I want to hold it for next 10 years, 15 years. So we have to go through this 10%, 15%, 20%, fall from its recent highs. So if you're feeling panic about some of the stocks you hold in your portfolio, remember, Apple had fallen more than 75%. What if someone would have exited saying, okay, I'm done with this business, and won't have enjoyed all the gains that Apple has now become the first company to hit $3 trillion mark. But to get to that $3 trillion mark, to enjoy that ride, we had to go through this roller coaster. John says, Hood lost arbitration. Yeah, I haven't been tracking Hood because I never liked the business. Their whole business model was based on meme, whether it's a meme crypto or meme stocks. So I don't like businesses which are only based on the flavor of the month or the meme stuff. But let me see what arbitration it had. Come on, cancel. Arbitrary rule that, okay, it was liable for a compensatory damage to retail investor. Yeah, the number is not big, but the optics is not correct. Number two is now there could be more lawsuits against Robinhood. Yeah, but they have to really show that Robinhood is more than just a business driven by retail investors who are fickle, right? Most of the crowd on the Robinhood is fickle in terms of want to get in, make some money, but if the market is not trending your way, it's difficult to stay in, and that's what we have seen. Large from a brokerage trading perspective, most of their revenue comes from the call options, from the options buying and selling. And from a crypto side, most of the revenue comes from Dogecoin, right? And these call options, a lot of retail investors jumped into buying call options in 2020 when the whole GameStop and AMC costs and all those meme stocks were making the headlines, right? The gamma squeeze happening on many of these shorted stocks. There was a huge option buying going on Robinhood, and it made tons of money through that. But now that particular segment isn't that active anymore. So not much coming from on Robinhood's way. So how does Hood make money on free option trades? Hood makes, so here's the business model of, it's not just Robinhood, it's a business model of all the stockbrokers. There is something called payment for order flow, PFOF, right? So if you maybe Google for it, it's called PFOF, payment for order flow. So when I buy or sell, I would either the stock or options, doesn't really matter, right? If I want to buy or sell a stock or option on any brokerage firm, they actually sell it to market makers, wherein the market maker, which is like, let's say, Citadels of the world, Susquehanna, Jump Securities, these are all the market makers who are ready to give you better pricing than what you can get it on exchange. But in turn, for the fact that I'm sending my order to, let's say, Citadel as an exchange, as a Robinhood, if I send the order to Citadel, they'll give me a few, 1/100th of a penny as a thank you gift, as a payment for sending the orders to Citadel for execution. So this is a business model for all the brokerage houses. The reason why the brokerage houses have been able to reduce the upfront cost, I've traded here and paid $7 per trade on Scottrade. Right? But as and when more and more market makers started to come into picture, the competition started to increase. The market makers started to give back some of the profits that they make to the stock brokerage firms to entice them to send the orders from their customers over to them. So every brokerage firm does it. You can go and look at their earnings, and by SEC regulations, they actually have to report every quarter how much money they made through payment for order flow. Okay. So when you send an order, you buy or sell anything on Robinhood, they sell it to market makers. Market maker will execute the order and send some money back to Robinhood as a, I don't want to say kickback, because this is it's a very prevalent business model in this brokerage industry. As a thank you note, saying thanks for sending the order to me. We've executed the order. Here you get 1/100th of a penny. But if you do the millions and tens of millions of orders per day, so 1/100th of a penny count a lot. So that's a business model. Now, why does only Robinhood is suffering and not why does Robinhood makes more money than maybe others? Is Robinhood, because Robinhood doesn't charge anything for options from us. If you're trading on options, the only way for them to make money is to demand a little better or little higher payment for the order flow from the market makers. And when the market makers give you a little more in a thank you note to increase their margin, they'll give the bad fills to their customer. So what do you mean by fill? Say I want to buy an option and it's available at say 95 cents on an exchange. Right? Market makers will come in and say they are ready to fill that for 94.95 cents. Yeah. Unfortunately, on an exchange, the pricing cannot be listed in, the lowest that you can go is a cent. You cannot go beyond, under that. So, but if I'm, let's say, trading it on Fidelity, then the market maker, the pricing that market maker may give me could be 94.80 cents. So you might still get cheaper than what is on exchange, but you might get a bad fill than as you would have gotten on some of the other exchanges. So if you have both the accounts, you might want to try out this experimentation. And I have done it sometimes. The pricing that I get on Robinhood is worse than the pricing or the fill that I could get on some of the other exchange, because eventually they have to make their money. So if Robinhood is giving me a free option trade upfront, if I don't pay 65 cents upfront for doing for an option trade, I end up paying maybe $2 or $5 through my back pocket because of the bad fills. Most of the retail investors don't realize it. Again, it's a question of where the money is coming from. Is the question where the money is, if the money is being taken out of a front pocket, like 65 cents, like Ramesh said, yeah, they do charge 40 cents, 65 cents, depending on how much broker charges for option trades, and it is negotiable. That's money coming from our front pocket. We see it right there on the screen where they say the option fee, the trading fee is 45 cents. We feel the pain because it's right up there. On a Robinhood, it shows a zero fee, but they take it from our back pocket because something that I could have bought at say $49, at 50 cents on Fidelity, I'm probably paying 55 cents on that same option on Robinhood. And you multiply 5 cents by 100 because each option contract is 100. I'm probably end up paying $5 more on Robinhood, but I don't realize it because I don't know what other brokerage firms might be paying. So I'm like, oh yeah, Robinhood charged me 55 cents. Probably that's the right price to charge. What I don't know is maybe other brokerage firms are charging only 50 cents for it because they're getting better fill. So that's a back pocket. And that's where, Robin, they make money on the payment for order flow you're right, John. You don't get the best fills on Robinhood. Then there are other avenues, but those contribute very less in terms of percent of revenue for overall Robinhood. They make monies. They make some interest margin money on your margins, the money that you take on margin. So they make some money out of that as well. But essentially, most of their revenue come from the transactions. Webull charges nothing for stocks or options. They charge per month 1.99 for real-time pricing. Again, most of these new brokerage firms, they don't charge you upfront anything for stocks and options. But what we have to consider, and unfortunately, this information is not, there is no comparison tool readily available to figure out what's the total cost of ownership. Right? So in case of Webull, or I have no experience with Webull, and I've never looked into, because they are not public, the information is not there. But we have to look at not just the initial cost of executing the transaction, but also what's the cost because we got a bad fill. We have to look at a total cost of doing the trade. While on a Robinhood or maybe on a Webull, I don't know, the initial cost is zero, upfront cost is zero, but the total cost of executing that trade could be more because of the bad fill. And that's something that we have to be aware of. So now once the whole stock mania had kind of died down, retail investors, especially the ones, who were very active on Robinhood, are taking little breather. Now Robinhood doesn't have any other, much revenue sources. So that's why their stock is where it is. They're trying hard to add other revenue sources. Recently, they had announced, they're moving into retirement space. That's how the rest of the brokers are able to, still give $0 for the stocks and maybe charge some cents for their options, but are still able to stay in the market because they got other revenue streams. They manage retirement accounts. They got advisory. They got portfolio management services. They got tons of other options available, other revenue, other income streams. Unfortunately, Robinhood doesn't have that. So unless they build out that other additional revenue streams, I just want to sit and watch. Otherwise, it's this whole depending on the retail investor mania is not the way to run the business. And unfortunately, Robinhood is learning that lesson. And that's where the stock is down from $70 to $14. Is there any broker that doesn't charge for SPX options? Robinhood doesn't offer XPX. Yeah, I don't know. I trade with most of mine is with TD Ameritrade, and they do charge for options. Cool. Let's look at the crypto side. What's happening with the crypto market? There's no point in pasting a chart for a crypto market because it changes so quickly. So I thought maybe I'll just have a link here. Maybe look at real time on what's happening on some of the crypto side. Okay, not not real bad on sideways. I think it's now finding its band between 40 to 45, 46 over the last few months. Nothing here to worry about. Again, depend on what your thesis is on these various crypto projects. We talk in detail on Thursday meeting. But same on Ethereum around 3,300, not a big change. Been between 3,000 to 3,500 for, yeah, I think it went down below 3K for a brief period of time, came right back up after the inflation news came in. Some of those crypto projects have performed better. Yeah, but nothing much to worry about here. This is a volatile. 5%, 10% change doesn't mean anything in this particular sector. So this is gonna wait and watch on what's happening over here. Other interesting chart which I saw was around yield curve. I mean, this discussion keeps coming whenever the market starts to go down, and you'll see economists talking about the yield curve and what does the yield curve tells us. So essentially, yield curve, it's not that the single plot of of one particular yield. Let's say treasury yields for 10-year treasury yield, 5-year treasury yield. That doesn't get much indication as much as the difference between a long duration treasury yield and a shorter duration treasury yield. That does tell us something. And over decades, it's been noted that the yield curve has been a decent indicator of market recession. Now, the degree of a recession could be different, but time and again, it has been found that the inversion in the yield curve is followed by turbulence in the stock market, turbulence in the economy, and then hence the turbulence in the stock market. And the most telling is the difference between the 10-year treasury and the 3-month treasury note. Now, eventually, if we are buying a longer dated treasury, right, as an investor, you would expect to be paid higher rates for it. Right? The APY should be higher. If I'm locking my money, say in a general investment, if I'm locking my money in a CD for 10 years versus CD for 6 months, I would want to be paid a higher APY on a CD for 10 years. Why? Because I'm locking my money for 10 years. Right? Economy, the outside of that, economy could do wonders. I'm taking the risk of putting the money for next 10 years, and I want to be compensated for that risk. That's why generally longer the duration, higher will be the rates on treasury bonds. That is our general, I would say the curve. That's the general direction of a treasuries. Now, it means for a shorter one, the rates will be lower. What happens if you take a difference of what happens if it actually starts to flip? That is called yield curve inversion. And if you Google for yield curve inversion, you will see the economists talking about that the yield curve inversion is a reliable indicator for market or economy recessions. In this particular plot, this is the difference between 10-year rate minus 3-month rate. So ideally, they should always be positive. 10-year rate should be higher than the 3-month treasury rate. So, which is what generally stays positive. But there have been instances whereas it has gone negative. 1969's, late 1960s, over here, over here, over here, over here, over here. And then recently after 2019, it went negative. And the ones which you see as red were the kind of recessions, or the stock market basically returned negative returns during these periods. So these were the recessionary periods in the economy. And that is why this is considered to be a more reliable indicator of what might be happening in economy. And some, if you really look at it from a logic perspective, it kind of makes sense. Is if you're increasing, let's say for 3 month or the short duration treasury rate are increased, it means the general interest rates will also increase. It means if the companies, their cost of capital to invest in the business will increase. So the companies may not be able to invest and grow their businesses, grow the capacity, grow the factory productions. So the investments, the capital investments will go slow, which is not good for economy down the line. And that is why could be a reason that it does tell on the economy if you are increasing your treasury rate in the short term. That might lead to a little decline in industrial output, eventually leading to decline in the economic output, which will then lead to recession. However, depending on the monetary policy, the recession could be longer or shorter. That depends on what Fed does to the interest rates. But that's the reason why this yield curve is an indicator that most economists would watch to figure out what the economy could be telling us in next 2 years. So generally the impact takes 18 months to 2 years to show up in the economy. Again, is it always? No. In some cases, probably take a longer. Some cases may not have been a perfect indicator, but I think this is the one which is more predictable than any other indicators that you could find in, not predicting, but in finding out if there could be recession coming or not. Again, it's all historical data. We can only look back at history and say, okay, we had a recession. These are what happened to the yield curve. Oh, yield curve inverted here. Great. We had some recessionary stuff here in 2000. What happened to the yield curve? Yield curve inverted here. And then based on that, going back to history, we found that this is probably a good indicator for what might happen in economy. So I thought this is an interesting chart. If you want to know more about it, there are good videos on YouTube, or I think it's better to look on YouTube. The literature doesn't explain it really well. But that is what yield curve and yield curve inversion that you might see being talked about in the financial media. Can you also link treasury yield to monetary policy? Yeah, so if looking at a yield, so if we are increasing the interest rate, so if you're increasing your interest rates, then the investors will also, they will get paid higher. Your treasury rates will also increase. So, but if you are holding the existing bonds, their yield will, their prices will fall down. So, but having a loose monetary policy, having a dovish monetary policy generally would mean your treasury rates will be lower. Having a hawkish one means you'll see an increase in treasury yields. Recent inverse yield of 2020 followed no recession, but we got COVID. Yeah, so when the COVID hit, the monetary policy completely switched. Right? The Fed took an actions which were unprecedented ever in the history. We printed 40% of the money that has ever existed in the last 300, 400 years in just 1 year. So that's what the flush of money that was being pumped by Fed, that helped to keep us afloat for some time. But now we are feeling the impact of it in higher inflationary costs. So somewhere someone has to pay you. We can't always keep creating money out of a thin air and keep kicking the can down the road. At some point of a time, we got to pay the piper. And yeah, that time will come. Some other interesting charts news, what I found, one from Vitalik, is a co-founder of Ethereum, which is paradox of diversity. If every organization within society must fully reflect the diversity of that society members, then there can be no diversity between the organizations of that society. It's similar to say, if everyone is thinking the same, then somebody ain't thinking. If everyone is trying to become the same kind of a diverse organization, that between the two organizations, there is no diversity. I agree. Next one is, you get rich by taking large amount of risk with small amounts of money. You stay rich by taking small amount of a risk with large amounts of money. This, I think, is a very important lesson as a retail investor. When we are following it with, or getting some stock or following some investor, we need to understand where they are in their journey. If I'm just starting my journey with a small amount, yes, I'll have to take little higher risk. This also agrees on, on the option side also, right? I don't want to risk any option trade which I do to be the maximum risk to be more than 1% or 2%. But if I'm starting with a very small amount, I have to take a little higher risk to generate some premium to make it worthwhile. That could be like 10%, 15%. But as you increase your account size, the amount of risk that you take with each trade has to go down small. And I completely agree. To retain wealth, you have to take a smaller amount of risk. We cannot continue to invest or take that huge risk. Let's put another, when we started, maybe put 25% in one in some of an expensive bet, which might pay off, might have a huge payout if it works. We can't do it if our account size is becoming bigger and bigger. So the way we invest has to change based on also the way our account has changed. Or we always pick up great companies and be okay with, have patience for those companies to play out. I would rather go that route than the first one, trying to take a huge risk. But if you want to get some adrenaline rush, maybe take a huge risk when the portfolio is small. The last one, your intelligence cannot be measured by a number. So IQ is not really worth it. It is defined by your willingness to learn, solve problems, try new things. You are more than just a number. Develop your skills, share your brilliant ideas. Your skills are more valuable than your grades, especially in this economy when the world is your market. Okay, we know the IQ is not interpreted the same way across the world. So it's our ideas, it's what we learn new. And nowadays learning is so easy. That's all it needs is a motivation to learn something new. YouTube, for me, YouTube has been the best university I would ever enroll into. There's so much of a content available on YouTube. Or if you go to those MOOCs, only thing that is stopping us from learning anything new is our internal motivation. I think access to knowledge is no longer a hindrance to learning. If someone's saying, it's just an excuse, to put it that way. If you want to learn, you can. There's so much of content available, and most of them is actually for free. You don't have to go to college to it. But we need to put in the time, we need to put in the effort, we need to have that motivation, we need to have that why factor of why I want to do it. I think how internet has already taken care of how you can do it. There's a lot of stuff available. The more important thing is why I want to do it. And that comes from our own inherent motivation. John says, Lucid 180-day lockup period ends next Wednesday. I wonder how many shares will be dumped. I haven't been following Lucid. So let's see what happens. Where is it now? What has it done? Largely sideways. But still, I want to wait and see how they perform in terms of how many cars they're able to sell, what's the traction, and we'll have a lot more time to invest in. For me, my EV players are right now the traditional automakers and a couple of Chinese players, things that we talked about last week. My EV players is Ford and GM and NIO, and then another, I think, Xpeng. Currently, stock market gurus are saying to invest in stable consumer companies or dividend companies like Home Depot, Walmart, IBM. So look at in terms of what's your investment horizon is. If you need some income from your investments in next 2 to 3 years, again, that depending on person to person and their risk profile, the mix of your investment would change. Right? For me, I'm a little risk averse. For me, if I need anything in next 2 years, I don't even have it in stock market. 2 to 3 years, any big purchases, it's not in stock market. I don't know. Markets could stay negative for next 2-3 years. I know that eventually in the long term, 7 years out of 10, it will be positive. I don't know which 3 years those would be. It could be this 3 year. It could be, 3 years down the line. Who knows? The sequence of returns, nobody can predict. So I generally don't keep anything which I need something for next 3 years. I don't keep it in the stock market. Beyond that, if I don't need it, then I don't need any returns from the stock market right now to live my life. I have a more willingness to invest in high growth companies, which could be a multi-bagger over a longer period of time. But it doesn't harm for us to have a mix of high growth plus stable companies, just because it becomes difficult to go through the volatility. Having these consumer stable companies for the next few years, because of the interest rates will be high, companies like Costco, Walmart, Home Depot, they will continue to do good. Right? Stable ones. You won't see a growth of that stock has become a multi-bagger in a few years. But yeah, it will be a less volatile stock and can help you in stay invested by all means. No. But generally, we should look at the total returns. So for example, IBM probably pays good dividend, but what's the total return? What happened to the initial capital deployed? IBM has been in doghouse for many years now. So I would be, again, this is not recommendation. This is what I am. What I would do is I look at the dividend, but I also look at what's the company doing. Is the dividend yield higher because the stock price is low, because the business is going down, and hence the dividend yield seems to be higher, then I don't want to own it. Right? Again, getting money from dividend but losing it on the capital side, not my style of investing. But if the companies like Home Depot, companies like Costco, yeah, they're growing their businesses, plus their dividend payout is also decent, yeah, that could find a place in my portfolio. So outside of dividend yield, also look at the overall return. By the way, if you don't want to do any deeper research, if you want to focus on dividend aristocrat companies are generally a good one. And there are even some mutual funds or ETFs that invest in high dividend paying companies. So you may want to look at that. But when these high growth companies not working, we will still gonna eat. We'll still use toilet papers, kitchen towels. That is why these consumer companies, they'll continue to stay in business. These are the things that we cannot live without. And that's why you might be seeing stock gurus talking about stay invested in these companies because they will continue to exist irrespective of what the market environment is. Another interesting chart. Innovative versus boring banks since the beginning of pandemic. So we talked about, right? Pandemic 2020 worst for financials and energy. 2021, both of them did great. And this is one, it's a kind of a little eye-opening chart. This is ARK Innovation ETF. And this is the S&P Regional Banking ETF. Right? Since the start of pandemic, which is almost now 2 years, both of them have returned almost equal. The returns have been equal. But the volatility in ARK, ups and downs that investors have to go through, have been huge than this boring banking stuff. If you don't look at this chart and you think or you ask someone which companies you think have outperformed in 2 years, everyone will bet on innovative big companies. But eventually the destination is same. Both of them took a different path to reach the same destination. This was a pretty interesting one. So boring investment could still be as profitable investment as this innovative stock or this thrilling investment have been. Again, I still think over a longer term, longer horizon, the great innovative companies will still outperform, right? But over last 2 years, this is an interesting chart to look at. Coming to some news, and I hate this news because whenever this is third time when I own a company with some thesis and someone else will snap it up. So now I have to change my investment thesis. So Zynga got acquired by Take-Two Interactive. Zynga was a pretty popular gaming platform during the initial days of Facebook, but then fell, sideways, didn't do much. Over the last few years, they actually started to focus more on increasing their mobile, and that's why I got interested in it. Because I like the way they were capturing and increasing their mobile presence. But looks like I wasn't the only one. Take-Two also liked that, and then they snapped it up. So this was a cash and stock deal. It is one of the video games industry biggest acquisitions. And now the Take-Two is expanding into mobile games through acquisitions. So they did a few more acquisitions, and then they now want to get Zynga as well. So If you are Zynga shareholders, the deal is at $9.86. It means including a $3.50 in cash and $6.36 in Take-Two stock. Now, if you're a shareholder, you have to make a decision. Do you want to just sell it and get out of it? Or do you want to get Take-Two stock? I have to decide. I don't think I'll be now sitting and analyzing for Take-Two stock. So probably I will sell my shares and get out of it from Zynga. But I hate when, I mean, one thing is okay that, hey, the thesis played out. The thesis has been validated. But then I don't like that someone actually snapped on the stock, which standalone probably could have done better than what now it would do as a part of Take-Two. Naresh, I have a long leap option of 2023. So I think once the deal is, we'll have to see what happened to so keep an eye on OCC. Search for OCC, what happened to the options on this deal. So I think Peter, I don't know how it's, because this is a half cash and half stock. What happened to your options? You might want to check that out. I mean, I had some stocks and I've been reducing the cost basis. So I kind of already made 50% reduction in the cost basis. And then now Take-Two is ready to pay another 60% higher. So eventually for me, it's from a return perspective, yeah, we made 60% in a quick short time, but probably might lose out on the longer term, lot more gains. It's okay. I mean, this is what it is. Some other company needs it more than what I need, so they snapped it up. Other thing that caught my eye was Block open sources Bitcoin mining system. It's exciting to see Block, formerly known as Square, going deeper and deeper into this ecosystem. I love both the ecosystems. I love fintech companies on the stock side, and also I love the ecosystem, Bitcoin ecosystem on the crypto side. Kind of Block is giving me the best of the both worlds. So they already announced, yeah, I think we talked during our crypto discussion, should have put in here, but because this also impact the stock side. On the Cash App, which is Square's app, Cash App for retail consumers. Now they integrated the Lightning payment network, which is built on top of Bitcoin infrastructure, into the Cash App. So now the users across the world, they can send payments to each other without actually owning, they don't have to own any Bitcoin, but the payment could be faster and way cheaper than what you would send it through wire funds or through the Western Union demons of the world, right? So that was another news on Square Cash App integrating the Lightning payment infrastructure into its app. But coming back to this one, Block wants to focus on creating a Bitcoin mining system, and now they open sourced it. In October, we announced we are considering building a Bitcoin mining system out in the open and alongside the community, and we've decided we are doing it. We thought we'd share some more details. So company is open to make new ASICs and has started evaluating various IPs, minor firmware, and blah, blah, blah. And now they decided that they will actually make it open source, make it easier and make its adoption easier and cheaper for anyone to get into this ecosystem for mining. We'll see how that plays out. But I like this announcement. I like this public listed company actually making great strides in helping this ecosystem grow. Another one on the Beyond Market. Wow, this stock used to be so popular again during the 2020 as well among the retail investors. Now this has become the most shorted stock. I think it has fallen. It hasn't found its house in terms of whether it's a meat or a plant, because the USP was it's a plant-based meat, and neither the meat looks like neither the meat lovers like it, nor the vegetarians or the plant eaters like it. So kind of in the middle of nowhere. So it was one of the hottest IP of 2019. And now the shares have tanked 70% since the market debut. And investors are betting, saying it could fall even more. So haven't been a great journey for Beyond Meat investors. Let's just pick up BYNT. Oh, that hurts. Anyway, so yeah, haven't been a great journey for investors. So because I see again, I don't know. I mean, there were some discussions that we have had around Beyond Meat, but I never got myself to invest in this one, because as a non-meat eater, as a vegetarian, I have no desire to eat something which tastes like meat, because I don't know what meat tastes like, and I have no need to do that. So I'm like, why would I try Beyond Meat? But I think it was more targeted towards those who are meat eaters, but want to be a little more go towards like green side, because this whole meat industry also contribute to the greenhouse gases and all that stuff. So I think they wanted to attract them to say, how can you reduce your meat consumption, but still get the taste of the meat. But I don't know. Does it really taste like a real meat? I mean, they claim that it's the texture and everything is like a real meat, but the jury, I think, is out there. Probably the sales are not increasing as what they thought it would be. So a plant in meat's clothing, that's essentially what it was. And despite some nutritional advantages, the Beyond Burgers contain 5 times as much as sodium as a ground beef patty. So probably it may not be as healthy as what it was advertised to be. So another one, high flyer. And company, it takes time for companies to have that staying power in the market. So we don't have to give into, a stock has gone up 50%, I think I should get in. We'll have a lot more opportunities to get into any stocks like Rivians or the Lucids or any others, these high fly stocks. Let them prove themselves. Let them prove themselves in the market. I don't want them to experiment on my money. Let them use someone else's money and do their experiments, and I'll get in once I've seen them performing in the market. And if they are really great companies, have been performing in the market, we'll have a lot more time to get on that ride. So we don't have to hurry. And lastly, from a news perspective, Ford hit all-time high. I continue to stay bullish on Ford. This is one of my EV players, along with GM and NIO and X9. But looks like it surpassed $100 billion for the first time. This is great. And their electric version of F-150 is due this spring. John says, grass-fed beef, the original plant-based meat. Okay. Anupama says, meat can be replaced by plants such as mushrooms or soybean. I think that's what, if I recall, maybe was it Beyond Meat or Impossible Burger? They have a pea, right? So they use peas to replace the meat. But again, I don't know from a taste perspective, how will it work out? Steve says, I have had vegetarian friends hand me a fake sausage link and say, try this. It tastes just like the real thing. I always thought the whole point of being vegetarian was not to taste meat. I mean, being Me being a vegetarian, yeah, I don't know. I mean, I haven't tasted meat. I don't know how it tastes like, so I don't miss it. You don't miss something which you never experienced, right? So, uh, some of my meat eater friends do ask me, I mean, you are missing a lot of stuff in your life. You haven't had meat or chicken. I'm like, how will I miss it if I don't even know, how it tastes like? So I don't miss it. But yeah, so I had no intention to try it out. Yeah, someone, if the question is, hey, you want to taste how meat is just out of a curiosity without eating meat, yeah, I'll go to Beyond Burger for that. But that's maybe one time. Then the curiosity is done. By the way, my daughter, she does eat the chicken nuggets, and she tells me that, and again, I have no idea. She tells that the taste, there's not much taste in the nuggets, but the most of the taste comes from the sauce that you add on top of it. I don't know. I'm like, what? These chicken nuggets are so famous, and they say, yeah, but Dad, the taste is in the sauce. Okay, I have no idea. Let me sip some water and then. Let's get into some earnings, and then we'll go into the Howard marks. And finally, we'll end up this session by looking at maybe the world's most important company and why I think it's one of the most important companies in the world. So quick earnings. This earnings season has been kicked off. And as always, financials are the first one. So this week, Wells Fargo reported, JP Morgan and Citibank, three big financial institutions, they reported their earnings. Wells Fargo beating estimates on top and bottom lines, means on the revenue side as well as on the earnings side. Overall profit was boosted by release of loan loss provisions. So Wells Fargo has done it now. JP Morgan's and some of the other investment, the banks that have got more investment, they're done it in previous quarters in terms of their loan losses provisions that they had kept in their income sheet. Now they're no longer keeping it. For those who probably new to this, during the COVID, when the COVID struck, every financial institutions was shaken to the core because they didn't know how long this stuff will continue, how much, what happened to the loans that they're given to the consumers, what will happen to the economic situation of the consumers. And maybe a lot of those loans could turn up to be bad loans. So what most of the financial institutions did was to set aside billions of dollars. I know JP Morgan had some $80 billion. They set aside billions of dollars as a provision in case, to serve as a cushion in case some of the loans turned out to be bad. Economy doesn't recover at all. Consumers are facing financial pressures. Now, as and when, then the Fed came in and flood the market and the consumers with liquidity. We didn't see economy actually getting into recession. Consumers' savings have been increasing. Basically, that's a reverse in the trend on American consumers. Actually, saving rates started to increase because a lot of stimulus check came in. So they made more money. And then you don't have to really hold up that much amount of money on the side, thinking that the loans will turn out to be bad. So now they released some of those loan loss provisions that kept some money aside as a provisions for a loan loss, right? So now they're saying, I think we don't no longer need that money. So that they got out of those reserves, and that also boosted some of their earnings. And if you look at many of the financial institutions have already started, some of them have actually started doing it 2 quarters ago, especially the JP Morgans and the Morgan Stanleys, those who have more trading revenue as well. Wells Fargo is also one of the most interest sensitive banks. And I hold positions. I've been bullish on Wells Fargo since it was mid-30s, has served me really well because they are doing a lot of changes in their operations. It's the most interest rate sensitive And the higher interest rates will lead to a stronger levels of profitability in future. Every banks have a mix of their revenues. How much revenue coming from their loans, mortgages, how much revenue coming from their trading and investment management activities, or your investment banking activities. So for Wells Fargo, a lot of revenue come from their loan and mortgage side. That's why higher interest rate might help Wells Fargo more than some of the other banks. So with Fed now expected, Fed confirmed to increase the interest rate 3 times, market expecting that it will increase the rates by 4 times, should work out well for Wells Fargo. Should work out well for Wells Fargo. That illustration. Efficiency ratio, which is how good they are able to do. The lower it is, the better is the outlook. So they reduce their efficiency ratio to 63% from 70.6%. So it was better than the street estimate of 70%. So they're operating better. Market conditions seem to be moving in a better direction for Wells Fargo. And they have had a lot of changes in past few years to basically, get through all the scandals that they have been in. So this is a bank that was beaten down because of those consumer scandals, right? Opening up of fake accounts, charging higher interest rate for their auto loans. Or might be, I think there was a news around selling some insurance on auto loans without consumers' approval, or not without, disclosing it really clearly to consumers. There were some scandals. I mean, Wells Fargo had multiple skeletons falling out of the closet. But eventually they got a new CEO. They made a lot of changes in their C-suite. And after that, the results have been positive. So I'm a happy shareholder for this. Will hold it, and of course reduce the cost basis, right? I think it's hit a recent all-time high, 52-week all-time high. Yeah, after the earnings results. So it still has some headwinds, which if removed, probably could result again in a better and more revenue and in better conditions for Wells Fargo, because the asset cap is still in place. So because of all the scandals that Wells Fargo had, Fed has told them you can't grow beyond a certain size. So while all other banks and the financial institutions, they can actually acquire other banks and grow their balance sheet, grow the assets under management, Wells Fargo can't. They have been restrained by regulators because of their actions of the past, the sins of the past. So regulators want to see them do better and better quarter after quarter before they lift that asset cap. So they are actually playing under the regulatory cap. So one tailwind could be lifting of the asset cap by regulators. Then Wells Fargo will be actually, playing in the market with all 4 limbs, able to move all 4 limbs at their will. Otherwise, right now, if they're like Wells Fargo is playing soccer, but hands are tied behind back by regulators. So once the asset cap is lifted, then management will be in a position to make all the financial decisions, what they want to make to run this company. So we'll see. I consider with a new management that's going to be positive for Wells Fargo. So I still stay bullish on it because they've been doing good and hoping that regulators will lift the asset cap if they continue to perform well. So that's another tailwind which isn't yet, we haven't seen that yet, showing up in the stock. or definitely not in the business because they can't grow. Even if they have money, they can't grow. Next is JP Morgan. JP Morgan again beat estimates, beat revenue. So it was a beat on the top line as well as on the bottom line. But market didn't like the stock because of guidance. And this is why playing earnings is always 50-50. It's a coin toss. You don't know what the stock will do after earnings. Sometimes stock like how the past has been and think that this is all going to be in future. Sometimes, earnings will overtake. Sometimes some other stuff will overtake the stock reaction just after earnings. So what we saw, so JP Morgan came and told there's a headwinds of higher expenses and moderating revenue. Why higher expenses? Because they have to pay more to their employees. Labor shortage, wages are going higher. That's a part of inflation that you can never turn it back. So they are, because of this higher expense, probably they will miss their 17% target of return on capital in 2022. Right? It's a tight labor market, which is forcing JP Morgan to pay more. And market really didn't like it. So if you look at JP Morgan, it is down more than 6% because of a guidance. Right. Next one is Citibank. Their net income actually dropped, and again, increase in expenses. That's why they didn't make that much money. That what they were supposed, they made it in the previous 2020 quarter. And I mean, this, I really don't know what to say about the Citibank because they've been kind of refreshing their business model for a few years. They're trying to figure out which areas to operate upon, which areas to not. Now they've exited their Asia business. They kind of hitting the going back to basics button. So I don't know. I don't hold this. I don't track this, but there's been a news sometimes of they're closing their businesses in one country, another country, or exiting some businesses. Yeah. So I think post earnings, it was a slight decline, but last day it was up. So earnings season is back, and I like this because it'll give us a time to look at some more the bigger companies that I'm more interested in. And but next week's we're going to look at a lot more financials companies. Generally, first week is a lot of financials companies will report their results, starting with Goldman Sachs, Charles Schwab, PNC Bank, Bank of America, Morgan Stanley is on Wednesday, Travelers Insurance is on Thursday, Regions Bank, Northern Trust, M&T Bank on Thursdays, and Friday it's Ally, Huntington. So a lot of financials. So if you hold any financials, ETF on financials or individual stock on financials, even though your company may not be reporting the result, but what's being reported by some of these big players generally give an idea to the investors on how the overall sentiment could be. And that means they might either buy more or sell the stocks that you might hold. So it could be a little volatile in the financial market, not the financial market, in the financial services stock for the next week. So if you hold some of those in your portfolio, brace yourself. I think we should hold some of the financials anyway, just from a diversification perspective. I don't know, any one of you hold these banks? The traditional financial services? Anyone? No one like banks? Come on, we just saw the banks were as good as ARKK. Rest says XLF. Yeah, that's a ETF. Rest says crypto only. We hate the traditional finance. Yeah, I have more on the crypto, but I do have a stakes on some of these financial companies as well. I'm not a maximalist yet. I'm a realist for now. Again, I come from my ideas. I'm an investor. So yes, I do hold cryptos plus some of the financials. Stevens is not currently measures Bank of America, MS, and JPM. Cool. Yeah. So yeah, next week's gonna be exciting for those who are holding financial services. All right. Next, I want to go through and spend some time on a memo from Howard Marks. Howard Marks has been one of a legendary investor, and his memos are very famous. There is a lot of wisdom hidden in his memos. So quick brief on who this person is and why is it that we're willing to spend some time. I'm willing to spend some time on his memo today. So he's an American investor and writer, co-founder and the co-chairman of Oak Tree Capital Management, which is the largest investor in distressed securities, right? From Warren Buffett, when I see memos from Howard Marks in my mail, they are the first thing I open and I read. I always learn something, and that goes double for his book. I haven't read any book, but I've read many of his memos, and they are full of good information, something that we as an investor should know about. Mark focuses on risk management and says investors should set investment strategy according to their personal. I think that's general. This is why it's also again important. Funds led by Marks have produced long-term returns net of fee of 19% per year. This is almost twice of the S&P overall market returns. S&P generally will return anything between 8 to 10%, 9-11%. Net of fee 19% is humongous. You can do it year after year. I mean, of course, probably this is not done year after year, but this is a long-term average. But if you can do 19%, nothing like that. You could be one of the top most investors in the world. It's not easy to do it. We can do it in 2020, but not every year is going to be 2020. So the results speak for what Howard Marks says. So his recent memo was around selling out. I think that's a pretty timely memo. So I won't go through the whole of it. It's very long, but some of the snippets from it and understand, what we learn from Howard Marks. And after that, we'll jump into reviewing the most important company. So this memo was around when to sell appreciated assets. I mean, this is a question I think every investor always struggles with. I'm struggling it right now. I have some shares that have appreciated a lot and still, are in profit. I mean, should I sell it? Could market go down? Should I still hold it? And then, see market falling down by another, 5%, 10%, maybe my stock falling down by 20%. That's a dilemma every investor goes through. So this memo puts something in context. So let's go through it. Can you share the links for Mark's memo? Okay, we'll Google it and share it. There is or if you just, let's do that right now. Howard Marks. Go to Insights, you will see the list of all the memos from Howard Marks. Yeah, so there you go, the selling out. So what's the basic idea? Everyone is familiar with the old song that's supposed to capture investing basic proposition: buy low and sell high. Right? This is a starting point of discussion for a very complex process. I mean, it's easy to say, as an investor, we should buy low and sell high. So that's how you make money. Right? However, regardless of the details, many people may unquestionably accept that they should sell when your investments have gone high. Buy low, sell high. So you should sell your appreciated investments. But what he's going to question is, how helpful is this basic concept? When he talks about, the origins of, he had another memo in 2015 called liquidity. And this is where the thought started to origin. And eventually, what he finds, long-term investors have an advantage over the ones which have a short time frames. But holding is easier said than done. I completely agree. The reason why I had stayed out of market for many years was it was difficult for us to hold when you see that the stock that you bought actually gone down 40%, 50%. Mentally, I wasn't ready for it. Number two, I did not know about options, so I did not have any idea about what I'm going to do. Am I just on the mercy of the markets? What if markets turn around? Right now it looks good. What if markets start to turn around? Is there any way for me to stay invested, but reduce the impact of market turnaround? So when I started, that's the reason why I actually started learning about options, is because to make it easier for me to stay in the market. If you have a band-aid, you can put on a wound for somebody. It's easy of a little bit of a pain, because it gives you a little more strength to carry on. So now, because after being on options, I've become a better in holding my investments, because I know it will take time to turn around some of those investments. But meantime, let me reduce my cost basis. Let me generate some income stream to it, because now we have those choices. So it is easier said than done. It's not easy. Too many people equate activity with adding value. Right? It's a pretty do. Let's make some profit and then get back in. But when you find an investment with a potential to compound over a long period, one of the hardest things is to be patient and maintain your position as long as doing so is warranted based on the prospective return and risk. We looked at the chart of Apple. It demands tons of patience to actually enjoy the return. Now it's easy to look back and say, gosh, I should have bought Apple when it was at $20. But if our mindset is not what it should be, we would have actually sold when that $20 hit $60. Investors can easily be moved to sell by news, emotion, and more importantly, the fact that they've made a lot of money to date, or the excitement of a new, seemingly more promising idea. As a retail investor, at least I have suffered through this. This stock has gone up. I made 2x on it. And now I'm looking at something else, which seems to be more promising. Everyone is talking about that stock in the market. I'm like, maybe that has got more potential. So sell that winner and invest in the other one. Probably I should have been doing the reverse. But, we are all guilty of, we are all learning here. And again, that's why I love reading through this, because it still taught me a lot more stuff that where I as an investor need to improve upon in terms of having the right mindset to invest. Everyone wishes they would have bought Amazon at $5 on the first day of 1998, because it's up 660 times. Isn't that the first thing we hear when talk about someone saying, hey, I want to invest in Amazon? Gosh, you already missed the boat. Should have invested when it was $5. But who would have continued to hold when the stock hit $85 in 1999? 17x in less than 2 years. Most of us would have sold it, saying, let's bank the profits. Okay. Even if you held it, who among those who held would have been able to avoid the panicking in 2001 as the stock fell down 93% to $6? Look at the volatility. 6 to 85, 5 to 85, and back to 6. Okay, you already take excess $6. Anyway, there's nothing more to lose. At max, I can lose $6, so let it be there. And who wouldn't have sold it by 2015 when it actually hit $600, up from $6, which is like 100 times. Yet anyone who sold at $600 captured only the first 18% of the overall rise from that low. It's not easy, but I guess we got to train ourselves. So I started watching Amazon when it was around 600, 650. And I thought, damn, it's too expensive, because it was $400 a few years ago, and it's already appreciated 50%. How high can it go? I don't want to, I'll wait for it to fall down. I think it's already too high. At that point of a time, I had not gone into the habit of actually looking at the company, looking at the business. I was more focused on what's happening in the market. What is chart showing up? Which ticker are people talking more about it, right? I hadn't trained myself to start looking at the businesses then. And I watched it. And eventually then I started looking, let's look at what Amazon does. I mean, I know it does e-commerce, but then I started looking at the mode that they have through AWS, the other businesses, the advertising businesses. Now Amazon is a big on advertising. The other modes that they have, like a Twitch, etc., which are like their future growth. Like, I think it's cheap. I eventually made my first investment when it was around $1,600. I watched it from $600 to go it all the way to $1,600. And then I thought, I think I should get in now. Now I would say I'm still a happy investor. It's doubled since then. And I think I will still hold it. There are a lot more tailwinds behind it. But I was watching the business. I wasn't watching the business at that point of a time, but we got to train ourselves to move from watching the candles to watch the business. Another one. This reminds me of the time once I visited Malibu with a friend and mentioned that Ringe family is said to have bought the entire area, the entire 13,330 acres in 1892 for $300,000. It's clearly worth many billions today. My friend said, I would like to have bought all the Malibu for 300,000. My response was, we would have sold it when it got to 600,000. And that is why it's, for me personally, it is difficult, even in this downturn, to sell some of those businesses which are down 40%, 50%. But I still have a conviction at a business level. The stock is down because I don't know which one of those will actually turn out to be Amazon, Malibu, Netflix of the world. I have absolutely no idea at this point. I know these all are good businesses. Some of them will fail. In a few years, maybe. Right now they all look good. Maybe management doesn't execute, but some of them could become great business. I don't know which one. So I have a difficult time in selling because I have had those instances where I sold in thinking that I'll get back to it and never got back to it because out of mind. Once you sold it, you made your gains, and then you say it going higher. It's as a investor, it's very difficult for us to buy something that I've sold at 80 and to go back and buy it at 100. I'm like, no, I think it will come down to 70. No, it will come down lower and then goes higher. Then suddenly you're just out of it. So to stay sane and see your stocks going down 40%, 50%, only thing that I will do right now, on those long-term holdings, okay, let's reduce some impact. Let's sell some call spread to still hold the shares and reduce the impact by little bit so that I can stay invested in it. There are two main reasons why people sell: because they are up, which we just looked at, and because they are down. Right? So selling because it is up. In short, a good deal of selling takes place because people like the fact that their assets show gains and they are afraid that the profits will go away. So it's up, let's sell it, let's bank the profits. What could cause an investor more self-recrimination than watching a big gain evaporate? I told you so. Should have sold it when it was high, and now you're down 40%. That's one reason. But if you sell an appreciated asset that puts gain in the books, it can never be reversed. Thus, some people consider selling winners extremely desirable. They love realized gains. I feel good. We realize our gains. Now market can't take those gains back from me. If it is unrealized, then depending on the market, those actually could lose. Right? Those gains could become losses. I'm not saying investors shouldn't sell appreciated assets and realize profits, but it certainly doesn't make sense to sell things just because they are up. Right? Selling because it has gone up 2x, that doesn't make sense. Selling for other reasons, and maybe in some other session we can talk about when to sell or why should I sell. So just selling because it's up doesn't make sense. Now let's talk about selling because it's down. As wrong as it to sell appreciated assets solely to capitalize gains, to crystallize gains, it's even worse to sell them just because they are down. Nevertheless, I'm sure many people do it. Probably has happened in this past few weeks on many of those high growth stocks. In fact, just as continued buying of appreciated assets can eventually turn a bull market into a bubble, widespread selling of things that are down has a potential to turn market decline into crashes. And bubbles and crashes continue to happen because investors contribute to excesses in both directions. Going back to our market cycle, I feel good about my investments. Oh, I think I figured it out. Although when I look into the mirror, I see a Warren Buffett, and then, that's our exuberance, which results in bubbles. And now panicking, selling it, stock is down 40%. I don't want to have any of it. I'm going out. I hate this stock. The same stock that I loved at 80, now I hate it at 40. Again, extreme behavior in other direction. In a movie that plays in my head, a typical investor buys something at 100. If it goes to 120, he says, I think I'm onto something. I should add more. And if it reaches 150, he says, now I'm highly confident. I'm going to double up. On the other hand, if it falls to 90, I'm going to think about increasing my position to reduce my average cost. Right? Let's reduce our cost because now, because I can now buy more at a lower one. But at 75, conclude, maybe I should reconfirm my thesis before averaging down further. At 50, you'd say, I would better wait for the dust to settle before buying more. And 20, I think it's going to 0. Let me get out. See the journey, the different emotions that a general investor go through it. It's not easy. Definitely not easy. But to get those gains that we see in Apple, in Amazon, or many of these great companies, those who actually made money on them have gone through all of this. Right? So whatever helps you to stay in the market longer, use that. If that means, for me, the fact that I can keep reducing my cost or buy it at a cheaper than the market has helped me to stay longer in the market and not worry about whether it will go up or down, because I'm not putting a line in the sand. I'm like, oh yeah, market is going down, fine, I will reduce some of the impact, but I can still stay in it. Whatever works out, you got to figure out for yourself. If that means not logging into your brokerage account or for a month, so be it. Just like those who are afraid of surrendering gains, many investors worry about letting losses compound. They might fear their clients will say, or they'll say to themselves, if we are retail investors, what kind of a lame brain continue to hold such a security after it's gone down from 100 to 50? Everyone knows. Emphasis on everyone, as if people have a crystal ball. A decline like that can foreshadow further declines. And look, it happened. I told you. You're a fool. You're holding Apple. You're holding Amazon when it was 85. It gave you the gains. It was up 17 times. You're greedy. You didn't sell it. See, everyone knows these things will come down. But studies have shown, another interesting, that average mutual fund investor perform worse than the average mutual fund. How can that be? If I'm investing in a mutual fund, as an investor, I perform worse than the returns given by mutual fund itself. It is possible because on average, mutual fund investors tend to sell the fund with the worst recent performance and miss out on their potential recoveries in order to chase the funds that have done the best and thus likely to participate in the return to earth. Here is most of the question which I get is, what do you think about stock because it hit a new all-time high? I don't know. I've never looked at their business. Because now suddenly everyone is interested in it because it's at its best. Nothing wrong in it. But if you have not looked at the business when it was actually down, then you got a question. Including me, I have to question myself is, should I just buy it because it's up? Or should I spend some time in seeing what this company do, why they will continue to be up? So what about the pros? Here the evidence is clear. The powerful shift in a recent decades toward indexing, another form of passive investing, has taken place for a simple reason that active investment decisions are so often wrong. And this is coming from someone like me who is actually active. But I agree to this in terms of if you say act, I don't trade in and out of my long stock positions. I'm active in terms of reducing my cost basis. But I think the recent, after this 2021, out of 48 mutual funds, I think it was a study on the CNBC or somewhere, or maybe Barron's, I don't recall. 48 mutual funds that they were tracking, only I think 3 have outperformed S&P 500. Or the indexes that they were tracking. I shouldn't say S&P 500 because I really don't know if they were tracking S&P 500. Out of 48, only 3 have done better than the indexes that they were tracking. So, and this, we have seen it for decades. Passive investing hasn't grown to cover the majority of US mutual fund capital because passive results have been good. It's because the active management is so bad. Another interesting thought. Superior investing consists largely of taking advantage of mistakes made by others. Clearly, selling things because they are down is a mistake that can give good buyers great opportunities. That's why a watch list of great companies that we've analyzed, we've looked at, comes handy at these times. Hey, if it is down, but there's no change in the business. There's no change in the outlook of the business. Maybe someone is actually handing out a great opportunity to us. So other question is, okay, if you don't want to sell when it's up, selling when it is down is also not good. So when should investors sell? If you shouldn't sell things because they're up, you shouldn't sell because they're down. Is it ever right to sell? That's a genuine question. When should I sell? So I'll quickly read through some of the conversations that he had with his son. Again, a little more thought-provoking to understand more about investing mindset. Howard, hey, I see XY is up XX% and selling at a P ratio of this. Are you tempted to take some profits? And Andrew said, Dad, I've told you I'm not a seller. Why should I sell? Well, you might sell here because you're up so much. You want to put some of the gain in the books to make sure you don't give it all back. I've done many times. I'm guilty of doing that. And at that valuation might be overvalued or precarious. And no one ever went broke taking profits. We hear all the time. I mean, I'm guilty of saying some of these as well. Well, we all got to learn. Yeah, as a response from someone, yeah, but on the other hand, I'm a long-term investor and I don't think the shares as pieces of paper to trade, but as a part ownership in a business. The company still has enormous potential. Amazon went to 600 from $6, but company still had a lot of potential. I can live with short-term downward fluctuation. That's the reason why I mentioned earlier, I don't want to put any money in the stock market that I need for next 3 years so that I can live through these fluctuations. I'm trying to become a better investor. The thread of which is a part of what creates opportunities in the stocks to begin with. Ultimately, it's the long term that will matter. Question, but if potentially overvalued in the short term, shouldn't you trim your holding now and pocket some of the gains? Then it goes down, you have limited regret, and I can buy in lower. And this buy in lower right now is probably going through the minds of a lot of investors. The market seems to be choppy. Interest rates are going higher. Won't work out good. Maybe sell now, goes down, I'll buy more. I'm still bullish on the stock, but maybe I'll take advantage of the choppiness in the markets that are expected near term and buy lower. The answer is, if I owned a stake in a private company with enormous potential, strong momentum, and a great management, I would never sell a part of it because someone else offered me a full price. Great compounders are extremely hard to find, so it's usually a mistake to let them go. Again, depends on what kind of a stocks you hold in your portfolio. And that is why it's easy to get a stock taste or difficult to build that conviction. And unless we have that conviction, we can't hold through those compounders. And only way we build conviction is to study more about that business and what's happening in terms of their earnings, their growth, their revenue. The chart doesn't tell us that. And I think it's much more straightforward to predict the long-term outcome for a company than the short-term price movements, which I think is true. If we are investing on, say, long-term, what I call as mega trends, it's easy to say. 10 years ago, e-commerce mega trend, everyone knew it. We know that the penetration of internet will continue to go higher. The adoption of mobile phones will continue to increase. It's an easy trend to predict. What is difficult to predict is, what is Apple going to do in the next quarter? But easy to see or to predict or to think about. I think if Apple continues to stay good in this mobile, it's a great future that lies ahead for Apple or for any other, good e-commerce company. What's not possible, and that is why if someone asks me, what do you think of this company? I don't know what's going to do in the next few months. It's impossible to predict. It's easier to predict the long term than a short term price movements. But we actually trade based on a short term price movement. We make a decision on what a stock has done in yesterday. But actually, it doesn't make sense to trade off on a decision in area of a high conviction about which you're limited to a low conviction. I mean, I'm making a decision based on what has happened in the short term on which I have a low conviction. It just doesn't make sense to do that. So next question is, isn't there any point where you begin to sell? In theory, it is. I'm not married to a stock. I mean, the other mistake that investors can do is get married to it. Right? That you start ignoring the fact that it's no longer the same business that you got into. It's no longer the same management. It's not, they are not aligned with what you thought is a great business to be in. So in theory, there is a reason to sell, but it largely depends on whether the fundamentals are playing out as I hope, and how this opportunity compares to others that are available, taking into account my high level of comfort with this one. So when you're selling it, we have to make two decisions. Number one is selling the current one. Number two is where to put this money. It's a more mental burden. Now you have to make two decisions. Once you sell it, what am I going to do with that money? Now to find something else which should give me better returns than what I'm currently holding on. Right? Aphorisms like no one ever went broke taking a profit may be relevant to people who invest part-time for themselves, but should have no place in professional investing. We invest part-time. I do it for myself, but I want to do how the professionals should do. There are certainly good reasons for selling, but they're nothing to do with the fear of making mistakes, experiencing regret, or looking bad. Us as a retail investors, we are in a great positions that no one can actually force us. If you are running a mutual fund, or if you're running an ETF, unfortunately, you don't control, because if the redemptions happen on mutual fund, you have to sell the stocks that you hold. Now, ARKK, if the ARKK unit holders start to sell it in the market, Kathy has no other option but to sell the holdings underneath it. I'm not tied to that. Even though Kathy might love, say, Tesla, her biggest position. But if most of the ARKK retail shareholders or whoever holds the ARKK start to sell it, she has to sell Tesla. I'm not bound to that. As a retail investors, we are free to make our own decision. There are closed-ended mutual funds. That mutual fund you invested in, now to liquidate it, so you have to sell those stocks. So switching gears. What about the idea of selling because you think the temporary dip lies ahead that will affect one of your holdings or the whole market? This is what I think we are going through now is maybe the stock market will not return what is returned. A pretty valid question. I'm not downplaying the importance of that question, or maybe it's pretty valid thing. It might happen. Who knows? No one knows. But this is a question that we need to answer. So there are real problems with this approach. Why sell something you think has a positive long-term future to prepare for a dip that you expect to be temporary? Which we know. In the long-term, markets goes up. 70% of the time, markets goes up. 30% of the time, they'll stay down. So why do I need to think of selling something which is long-term will work out to prepare for something which will happen only 30% of time or is temporary? Doing so introduces one more way of doing wrong, since the decline might not occur, number one. Okay. Or Charlie Munger says, pointing out that selling for market timing purposes actually give an investor two ways to be wrong. The decline may not occur, or if it does, You'll have to figure out when is the right time to go back in. Okay, I sold it. Now Zoom is down 50%. Should I get back in? That's another decision that we have to make. Or maybe there's 3 ways. There are 3 wrong decisions. Because once you sell, you have to decide what to do with the proceeds while you wait until the dip occurs. It may not happen immediately. So people who avoid declines by selling too often may revel in their brilliance and fail to reinstate their position at the resulting lows. No one has been able to capture the lows. Thus, even sellers who are right can fail to accomplish anything of lasting value. Lastly, what if you're wrong and there is no dip? 2020, we all thought COVID, March 23rd, world is gonna stop, markets fell on 30%. I'm sure there were investors that would have just gotten out of it, just thinking the world is going to hell. And you missed out, and that dip didn't occur. No one expected the actions from the Fed. No one, including the professionals one. I think everyone, including the Wall Street people, they all thought it's going to crash further down. No one expected that that Fed will step in and do what they had done. Yeah. So it's generally not a good idea to sell it for the purpose of market timing. There are very few occasions to do so profitably, and very few people who actually possess the skill to take advantage of these opportunities. So don't try to time the market. Right? Coming to almost the end, the bottom line is we should base our investment decisions on our estimate of each asset's potential, not that I think it's gone up so high. Does it still have a potential? Is there still a lot of TAM that is still to be captured? We shouldn't sell it because the price has risen a position as well. There can be legitimate reasons to limit the size of positions we hold. And that could be one reason why you may want to sell. There are reasons that why you should sell something. And we can talk about those reasons. I have my own reasons. But there is no way to scientifically calculate what that limit could be. Right? For example, my reason is I don't want let any position to go higher than 15%. Any stock position to go higher than 15%. Right now, below that. So I'm okay. But if it goes higher than 15%, I might want to trim something out of it. Right? Helps me to sleep well in night. Anything that, at the end of the day, no investment is worth losing sleep. So if it helps me to sleep well in night, even though I might be losing out on some future gains, it works out. It will work out for me. In other words, the decision to trim position or sell out entirely comes down to judgment, your own personal judgment, not what the stock has done or what the stock price has done, how you value that business. It's clear to me that being invested is by far the most important thing. You can try to add to returns by engaging in machinations of selling in, getting back in at a lower price, but these actions are unlikely to work at best and get in the way of making higher money at the worst. Guys, if you have time, I mean, I've read through the things that I thought I would like to cover in this. It's a much longer letter, but if you have a time, go ahead and read it. It's a good exercise to become a better investor. Time and again, at least my personal experience is investing more about mindset than about finding great stocks. Or you can find great stocks. Subscribe to some good fundamental subscriptions. There are many out there. Read about the stocks and totals. But developing mindset, no one can help. I can't help you. Stock Tweet can't help you. FinTweet on Twitter can't help you. The stock market gurus on CNBC can't help you. You got to train your own mind to become a better investor. And lastly, in the post-war period, US stock market has gone up around 70% of the years. odds much less favorable than that have made casino owners very rich. Yet most investors try to guess the 30% of the stock time that when the stock will decline. Isn't that crazy? We all are thinking about, oh, the market is going to go down. And we focus a lot of our attention, a lot of our energy around the things that happen 30% of the time, and we ignore the things that happen at 70% of the time. This was an eye-opener. This Howard Marks letter, I think you should spend some time on it. Right. Let me sip some water and let me know your thoughts on this one. Okay, Anupama left. That's fine. Sam, how do you become so brilliant? I'm not brilliant. I'm just trying to become a better in just holding and understanding the companies, Sam. The more I study about the market, more I realize brilliance and the IQ has nothing to do with investing. It's more of a mindset. Thank you, everyone. Those who are doing on joining on the crypto side, we'll talk again on Tuesday. A lot of exciting stuff and development happening there as well. Again, from a business perspective, I don't know where the crypto stocks, the token values will go. Well, that keeps going up and down 5%, 10%. But it's what I look at is a lot of exciting projects and the developments happening on the projects. That's really exciting. Cool. Yeah, let's talk again Thursday, or else we'll see you on Saturday. Goodbye, everyone.